Hey there, traders and investors. Welcome back to our channel. If you're a trader or investor, then you need to avoid these 3 common mistakes when using covered call strategies. Now, if you're new to options, trading covered calls can seem a little intimidating at first. But trust me, once you get the hang of it, they can be a powerful tool in your trading arsenal. Covered calls are a popular strategy for generating income from your stock holdings, but they can be tricky if you're not careful. Let's get into it. I don't think people understand the risk of selling call options too close to the current stock price. This is a common pitfall that can have significant consequences for your trading strategy. Now, I get it. You see that juicy premium, and you just can't resist, right? It's like a siren call, luring you in with the promise of quick gains. But here's the thing. Selling calls close to the current stock price significantly increases the chance of your shares being called away. This can disrupt your long-term investment plans. Think of it like this. The strike price of your call option is like a ceiling for your stock. It sets a limit on how high your stock can go before you have to part with it. If the stock price stays below the option strike price, you get to keep your shares and collect the premium. Sweet deal, right? This is the ideal scenario for many traders. But if the stock price goes above the option strike price, the buyer of your call option has the right to buy those shares from you at that price. This can happen quickly and unexpectedly. So if you sell a call with a strike price that's just slightly above the current stock price, even a small upward movement could mean you saying goodbye to your shares. This can be particularly frustrating if you believe the stock has more room to grow. And let's be honest, none of us want to miss out on potential profits, right? We all want to maximize our returns and see our investments flourish. We want our stocks to soar to the moon. The dream is to see our investments reach new heights. So how do we avoid this mistake? It's all about strategy and foresight. Instead of chasing those sky-high premiums, aim for a strike price that's comfortably above both your cost basis and the current stock price. This approach provides a buffer. This gives your stock some breathing room to move up without the risk of being called away prematurely. It allows for organic growth. Remember, it's a balancing act. You need to weigh the potential premium against the risk of losing your shares. You want to maximize your premium while also giving your stock the potential to grow. Finding that sweet spot is key to a successful covered call strategy. You need to hear this if you're a covered call trader. Let's move on to mistake number 2. Ignoring earnings announcements. Now this one's a biggie. Earnings season can be a wild ride for stocks. And ignoring it when selling covered calls is like trying to navigate a hurricane in a canoe. It's chaotic, unpredictable, and can leave you in a very precarious situation. Why are earnings announcements so important? Well, they can cause some serious stock price volatility, which can be both an opportunity and a risk. Think about it. Earnings reports are like report cards for companies. They tell us how well a company has performed over the past quarter, providing insights into their financial health and future prospects. Good news often sends stock prices soaring, while bad news can send them plummeting. It's a high-stakes game that can dramatically affect your investments. And when you've sold a covered call, that volatility can work against you. The swings in stock prices can be much more pronounced during this period. Imagine this. You sell a covered call on a stock with an earnings announcement coming up. You think you got it all figured out. The stock price is looking good and you're feeling confident. Everything seems to be going according to plan. But then bam, the company releases disappointing earnings and the stock price takes a nosedive. It's a scenario that can catch even the most seasoned traders off guard. Suddenly that call option you sold is now in the money, and your shares are at risk of being called away at a lower price than you were hoping for. This can lead to significant losses. This could also happen even if the earnings were good, but the guidance reported was bad, or the CEO follows up with additional negative news regarding the company's future. So how do you avoid this earnings season pitfall? Simple. Check the earnings calendar before you sell any covered calls. It's a small step that can save you a lot of trouble. Most financial websites and trading platforms will have this information readily available. Make it a habit to review this calendar regularly. By knowing when to expect earnings announcements, you can avoid selling covered calls on stocks that are about to experience a potential roller coaster ride. This way you can navigate the market with more confidence and less stress. Am I the only one that didn't know selling calls on highly volatile stocks can be a huge mistake? All right, let's talk about the third mistake. Selling covered calls. Selling calls on highly volatile stocks. Now I know what you're thinking. Those high premiums on volatile stocks can be awfully tempting. It's like the siren song of the options world calling you with promises of quick gains. But here's the thing about volatile stocks. They're unpredictable. They can swing up and down like a roller coaster. Well, that can lead to quick profits. It can also lead to some pretty significant losses. Remember, when you sell a covered call, you're limiting your upside potential. If the stock price skyrockets, you'll only make a profit up to the strike price of your call option. Now, that's not necessarily a bad thing if you're happy with that limited profit. But if you're selling covered calls on highly volatile stocks, you're essentially betting that the stock price won't move much, or at least not in a big way. And let's be honest, that's a risky bet to make with a volatile stock. So how do you avoid this mistake? It's pretty straightforward. Stick to stocks that are less volatile. Focus on low beta stocks that are slow, steady movers versus fast, volatile movers. Look for companies with a solid track record, a strong competitive advantage, and a history of stable growth. These types of stocks might not offer the same eye-popping premiums as their more volatile counterparts, but they also come with a lower risk of unexpected price swings. Remember, when it comes to covered calls, it's all about finding the right balance between risk and reward. Don't let those high premiums on volatile stocks lure you into a false sense of security. Instead, focus on achieving consistent returns with a well-thought-out strategy. A long-term approach with less volatile stocks can provide more stable and predictable outcomes. Make informed decisions and always consider the risk factors involved. A balanced portfolio is key to managing risk and ensuring steady growth over time. Are you worried about making mistakes in your covered call strategy? Let's recap the 3 key mistakes to avoid. The first mistake is selling calls that are too close to the current stock price. The second is ignoring earnings announcements. And the third is selling calls on highly volatile stocks. By being mindful of these pitfalls, you can enhance your covered call strategy and improve your chances of success. Remember, covered calls can be a great way to generate income from your stock holdings. But it's important to approach them with a clear understanding of the risks involved. Don't let greed or impatience cloud your judgment. Thank you for watching this video. And if you found this video helpful, be sure to like, subscribe, and share it with your fellow traders and investors. This video is part of a series on options trading for beginners. Stay tuned to this channel for more valuable lessons on stock options trading.